All right.
All right. So thanks everyone for joining us. Connie, take it away.
Hello, everybody. I am here at the behest of Ferramars Moyne ZIA, the best mortgage broker in the West and possibly in the East. I am a financial advisor. I work with Foci Wealth Management. And obviously, one of the things that I work with my clients on is homeownership. Owning your own home is probably one of the most important and biggest decisions of your life. Where do I want to live? How much is it going to cost? How am I going to pay for it? So it's a huge process with people who are sort of just hitting their stride career-wise and thinking, wow, maybe I could own instead of rent. What would that look like? And so as a financial advisor, we do want people to own their homes. It's a tremendous way to build wealth and to increase your net worth. And it's also a tremendous way to gain tax advantage because you have mortgage interest that you could deduct. But we have to look at home ownership in the context of all of the other pieces of each person or each couple's financial puzzle. So in addition to home ownership, what are your other financial responsibilities? Are you taking care of children? Are you taking care of a parent? Are you taking care of a spouse potentially who's unable to work? And what are the other bills that you might have to pay or be responsible for? And also, what are your financial goals? So in addition to home ownership, people usually have some other things that they want to try and save for. They might be saving in a college savings account for their kids. They might want to try and retire at 60 instead of 65. There's all kinds of different moving parts and pieces to each person's financial puzzle. I guess the other part of that is most people are very excited about saving and accumulating and how are we going to invest it so it's going to grow. And another part of it is what do we have to look at in terms of what holes there might be in your safety net? So if you need insurance, what kind of insurance do you need? How much insurance do you need? And how do we make sure that your financial journey is not derailed by something that we could easily have avoided by making sure that we have the proper kinds of insurance? So there's a building process when I'm working with those clients to evaluate their cash flow and to evaluate what are the assets that they have to work with in terms of purchasing a home. And then to look at the other goals in addition to home ownership. So you may qualify for a very, very, very large mortgage, which is great. That means you have wealth and you have income and you have a good credit rating. But taking on the biggest mortgage that's available to you might also mean that in paying that mortgage, you don't have any money left over to fund other things like college savings or retirement and so on and so forth. So there's a great collaboration that goes on between me and Ferramars. I try and get my clients prepared in terms of knowing what they can afford, not necessarily what they qualify for, but what they can afford and what makes sense and being realistic. And occasionally that means like, hey, let's wait another few months until you've accumulated this much more, or let's wait until you get that raise. But ultimately, once I have a general sense of my clients are ready to be owners, not renters, then I send them off to Ferramars so that he can take them through the process of the nuts and bolts of what do you need to do to qualify? What actually needs to be in place? And I just also want to put a shout out. We have Scott Halbrook with us today, who is a highly knowledgeable and skilled insurance agent, who is another person that I often pull into the equation. The types of insurance that financial advisors deal with is mostly life insurance or disability insurance or long-term care insurance. We're not experts in terms of property and casualty and sort of defending yourself against liability if you're in a car accident and things like that. So it's also really important to work that into the equation. I think that is most of what I have to say. Yeah.
Perfect timing, Connie.
'Right.
Usual. All right. So Thank you for being on this, you guys. It's great to have you here. So, and thanks for everyone who's attending. Like Connie mentioned, I'm in the mortgage business. I do residential mortgages. I've been doing this since 2004. After 20 years of self-employment, I entered the mortgage business and just fell in love with it. I love helping people find their homes, especially first-time buyers, like I think a lot of you guys are on the call right now. We can lend in all 50 states, but most of my business is California-based. I'm located here in Berkeley, California, in the East Bay. And our goal is really to serve you at a high level. That's the main thing. We want to have you guys feel comfortable referring us, your friends, your family, your coworkers. It's really the beginning of a referral relationship. You're not going to see my name on bus stop ads or screaming at you on the radio or anything like that. We do refinances, but our main focus is trying to do purchase business and help home buyers purchasing their homes. I work at Cross Country Mortgage. I'm the branch manager of the branch here in Berkeley. Cross Country is a very strong national lender. They do over $30 billion a year in loans, and that size and that volume really allows us to get some economies of scale and offer some competitive rates. We sell directly to Fannie Mae and Freddie Mac. No middleman involved. That means for most conforming loans, we can be very competitive when it comes to rates and guidelines and things like that. The size and track record of quality of the loan origination also means if you're looking for a jumbo loan, that we have a lot of jumbo investors. Investors in this case aren't people who put money into the company. They're people who aggregate money together and create jumbo loan products. So we'll get into some of the details of that in a little bit. We do all of our own underwriting, docs, funding happens right here at the company. It's all in-house, gives you a good local feel. I'm available, pretty much when you need me. And we have a great digital loan process where you can apply for loans online, upload all your documents. We have e-closing where you can actually e-sign a lot of your closing documents so that the closing is simple as well. So a lot of this is based on trying to be as smooth and efficient as possible so that we can get loans in and out quickly. What we're going to talk about today is the pre-approval process, the home buying process, and some of what matters when you're looking for who to work with as a lender. There's a lot of stuff on here that in and of itself could be a 1-hour seminar, right? But we're going to try to touch on the high level points so that we cover a broad stroke of really what this home buying process looks like. After the thousands of loans I've done, we've seen a lot of things, and we're just going to try to share as much useful information as possible. If you want to dig down deeper in any of this stuff, feel free to contact me. A couple housekeeping tips. On your Zoom control, you can certainly put something in the chat, but it would be more effective if you were to use this Q&A thing right here. Submit questions through Q&A. We'll try to keep an eye on that. You can submit any question you want along the way. We could take a pause and answer them. I'd like to make this as interactive as possible, or you can just sit back and listen to me drone on. And if not, then you can use the chat button. If you want to speak or have a question, you can also use the raising of the hand. But the Q&A is probably the best way to go. This meeting is being recorded, so if for some reason you missed some of this or anything like that, we're going to send out a link to everyone to catch the recording as well. So with that, let's get started on kind of what the process is in terms of the home buying. The first step is really pre-approval. What we really want here is to touch on the three things that you can control, okay? To get a loan funded, there's really 4 legs that table stands on, and 3 of them are your income, your assets, your credit, and the 4th is the property. We can't really control that at pre-approval because there's not, we don't know what the property is yet, but when we're pre-approving someone for a loan, these are the big 3 things we take a look at. So I kind of want to give you an overview of what goes into each one of these. As far as income, the real, the main buckets are you an employee or are you self-employed? Those are the 2 main buckets. Now, there are a lot of other, income types that we look at, right? There's retirement income, there's pensions, there's alimony, child support. We have some programs where we can take a large amount of assets and turn that into income. But generally, most people are going to fit into one of these 2 buckets, self-employed or W-2. Okay. And the question when we're pre-approving someone and looking at this information is, what is the likelihood of the continuance of this rate of income over the next 3 years? So for that reason, we take a couple of year look in the rear view mirror to see what has your income been. And in general, we're looking at 2 years of W-2s for people who are employed, 30 days of pay stubs. The W-2s give us a big picture view of how much you've made over the last couple of years. The pay stubs give us a more granular view of where your money comes from in the most recent pay period. And we want to see the consistency there. If you've had multiple jobs in the last couple of years, we'll take a look at all of your W-2s and see the pattern of employment there. If you're out of the workforce and re-entering it, in general, if there's no job gap, we can use your new income right away. We won't be able to use any bonuses, or we won't be able to use any overtime or anything like that. But your base salary, we can use right away when you're transitioning from one job to another. If you've had a long period of where there's been a gap in your employment, then we usually ask to wait to you about 6 months or so to reestablish employment and get a new pattern of income. But if you're just changing from one job to another, then that's fine. The thing that gets a little tricky with people's income when they're wage earners are things like overtime, right? So are you on bonus or commission? Both of those categories require us to take a look at a 2-year average and average out what you've received in your bonus or what you've received in your commission and your overtime. Again, if you have a second job, we can use that income, but only if you have a consistent history of it. So if you have factors like that, it's important to really get with a good mortgage person so that they can run your numbers, because what you think you're making every month might not exactly be what we can use in underwriting. And that disconnect often is a surprise to a lot of people. So the earlier we can look at that, the better. One other income that we run into a lot in the Bay Area with all the tech companies is compensation as stock. RSU stands for restricted stock units. And a lot of people are getting that type of income. Again, we have options in our portfolio of loans where we can actually use that RSU income and give you credit for it, but not every single investor, bank, lender can use RSU. So if that's a big part of your income, you want to make sure upfront that the lender that you're working with is definitely able to use that RSU income. The self-employed bucket has been really hit by COVID. When shelter in place came around in March last year, the lending world got thrown into a big state of, a lot of post-traumatic stress disorder from what had happened in the financial crisis, because the immediate fear was that the world's going over the cliff again like it did then. Thankfully, none of that happened. Things were a little jarring in March and April, but by summertime, things had not normalized, certainly in terms of day-to-day life, but in the financial markets, definitely settled down a bit. So what we did see, though, was the addition of COVID overlays to guideline, especially for self-employed, where they wanted to see the impact of what's happened with shelter in place and with what's happened to the economy and COVID and how that's impacted your self-employed business. So what we used to do was just 2 years of tax returns, average out the income. Now, in addition to that, we're getting a year-to-date P&L. So now that we're in 2021, we're requiring a 12-month profit and loss statement for the year of 2020. In addition to that, conventional lending is also requiring a more recent P&L covering just the last 3 months. So you have to bucket those two things together. We can help you with that stuff. The balance sheet, the profit and loss. If you're not used to putting that together, and if you're self-employed, then we have some templates that you can get with your CPA and fill this stuff out, but you don't have to start from scratch. There's a lot of great online resources too, sample P&Ls and things like that. It might sound daunting if you've never done one, but it's pretty simple. You just have to say how much money has come in and offset it with all of your expenses. And we want to check and see if that's been in sync with what your reported income has been over the last couple of years there. In addition to that, we're looking for 3 months of business bank statements. So if you have a self-employed business that's functioning, we want to see if that's supported by the deposits that are coming into your bank account as well. So, self-employed has always been a little bit tricky. It's definitely, I've worked with a ton of self-employed borrowers. It's very doable, but the COVID overlays have made it, even trickier now. one other big thing that affects everybody is the age of documentation. So once you engage in this process, get your uploading skills and your finger clicking ready, because you're going to be uploading a ton of PDFs because the age of documents expires quickly. There was so much market movement, there was so much change going on, and a lot of people were losing jobs and things like that, that what was normally a 120-day date of expiration for a bank statement or a pay stub has been shortened to 60. So we're continuously needing new and updated documentation. We're verifying people's employment right before funding to make sure that they haven't lost their job due to a downsizing or something like that. So there's just a lot more paperwork involved. It makes it even more important to work with someone who really knows what they're doing. So that's it on income. And again, if you have any questions, type them in. Happy to answer on that. When it comes to assets, what you're looking at here is a big pile of cash, which is definitely not okay. We definitely do not want you to show up with a bunch of cash. That's not allowed under any guidelines. If you can put it into your bank, in terms of the documentation requirement, we need 2 months of bank statements. So, once you've deposited the funds into your bank and we have two months of bank statements that don't show those deposits, then you don't really have to source those funds. You have tax consequences and things like that to consider for sure. But from a lending guideline standpoint, we really only need the 2 months of the most recent bank statements. And then that money for our purposes is yours. If you don't have enough money yourself and family can help you with your down payment, gift funds are allowed pretty much across all of our platforms. So whether you're going conventional FHA or getting a jumbo loan, we do have programs that allow gift funds. There's some guidelines that get into how much you have to put in and how much gift is allowed, but we do have programs where 100% gift is allowed as well. So it does have to come from a family member, and then it does have to be supported by a gift letter, which we'll supply to you. And the gift letter pretty much just states that, I'm giving my daughter's son this amount of money. We expect no repayment, and this is the source of the funds. If you're getting an FHA loan, then there's one more layer of documentation required where we have to source the funds and make sure that that person giving you the money we get a bank statement from them showing that they had the money to give. If you're getting a conventional or a jumbo loan, then all we really need is the gift letter, and we can help coach you through that. It's always a better idea to not receive the gift funds into your personal bank account, because once you start to commingle funds, things get complicated. It's not a deal killer by any means, but it's definitely better to work with someone early before you start transferring funds around. Lots of transfers of assets are a common thing that jumps out at and ends up biting you in terms of more paperwork. When you're getting a jumbo loan, in addition to your down payment and your closing costs, then you're also required to have reserves. On some conforming programs as well, some conventional programs as well, some reserves are required. What reserves are the amount of reserves are based on what we call the PITIA. So the mortgage payment, your monthly taxes, your monthly insurance, any mortgage insurance that's required. We take that monthly number that you pay every month for your house, and we multiply it by whatever the reserve requirement is. That could be 3 months, 6 months, 12 months of payments. In some cases, 18 or 24, depending in the jumbo world. So when it comes to reserves, you don't have to have it as cash. You can use retirement assets. We can use brokerage assets and things like that. Again, you can do a whole 1-hour seminar on that stuff. But again, if you have any questions about that, let us know. But that's the general feel for assets. So once you have the assets in and documented, how much do you really need, right? So the most liberal 0% down is the VA program. It's for veterans only. You can literally have 0% down. If you've served in the military, we're great at doing VA loans. The rates are great, and you can put 0% down. There is a funding fee that gets added to your loan, but it doesn't really impact your closing costs. So if down payment is a concern, then that's great. One thing about VA loans, the property has to have what we call Section 1 clearance. So when a company goes out to do a pest inspection on a VA property, they're going to come up with Section 1 and Section 2. Section 1 is live organisms like termites and mold and mildew and infestations and things like that. That stuff all has to get cleared. Section 2 is more recommendations on structural things, and Some of that could get pulled into depending on what it is, but that's something to keep in mind on the VA loan. So conventional, conforming, Fannie Mae, Freddie Mac, all these terms are interchangeable. They basically mean the same thing. Most loans are conventional loans in the country, and they adhere to Fannie Mae and Freddie Mac's phone book size, list of guidelines. They tell us how to evaluate income, assets, credit, things like that. So when we're looking at those requirements, one of the guidelines they have is the maximum loan limit that they'll allow, and that changes every year. So the national limit right now for the U.S. is $548,250. We do a lot of loans in California, and a lot of California, locations are what we call high cost areas. So places like the Bay Area, LA, places like New York, or any place that has really high home prices, they can go to 150% of whatever that national limit is. So in this case, this year, it's 822,000. So up to that national conforming limit of 548, you can put as little as 3% down. Up to 822, you can put down as little as 5%. If you're looking at a jumbo loan, anything above that 822 number, then we have 10% programs that take you all the way to $1.5 million, where you could buy let's say a $1.6 million house with a 160,000 down. In addition to this, there are down payment assistance. That DPA stands for down payment assistance programs for FHA and conventional loans, where you might not have to come in with anything at all, where you can actually borrow. The state of California has one through CalHFA, the Housing Finance Authority of California, where there's 3 or 4 different loans that they have available that can pile together and give you assistance if you qualify. So it's based on where the property is, what your income is. There's different qualification metrics on that. So again, that's something that we can help you with. So that's that's an overview of assets. The next thing that we want to talk about is credit. And the big question, there's a lot of misconceptions out there about credit and what really makes up your credit score, right? So what is my credit score and why do I have this credit score is a question that we get into a lot with borrowers. As you look at this circle shows you how your FICO score is created and calculated, right? By far, the most important factor is your payment history. If you have late payments, then you're going to have a lower credit score. If you make payments on time, you're going to have a higher credit score. It seems simple, but that's the main thing. The next biggest is how much you owe on every single one of your credit cards. So when we pull credit, every one of your line items, we call a trade line, right? So a credit card is a trade line, an auto loan is a trade line, student loan, all these things. So how much you owe on each one of these is a big factor versus the balance limit allowed. Now, installment loans like a lease or something like that don't really factor in terms of the percentage of how much you owe. But credit cards, home equity lines, and any kind of revolving debt like that, how much you owe at any given time is a big factor versus the amount of your limit. So if you have a $10,000 limit credit card and you've charged $9,900 on it, that's going to have a real negative impact on your credit score. I have a lot of clients who come to me for the pre-approval, and one of the questions we ask is, are you using your credit card to live every month and paying it to zero to get points or miles or something like that? If you're doing that, that's great, especially if you pay it to zero every month. You're getting points and miles, you can take a vacation with that. But the credit companies don't have your history of paying it to zero every month. When we pull credit, they just look at what the balance is right there. And they don't know if you've been carrying that $10,000 balance and struggling with it for 2 or 3 years, or if you run it up to $10,000 every month and pay it to zero. So if that's something you do, we want to wait on pulling your credit until you've been able to pay your balances down, and then pull credit once we've been past the payment billing cycle. We want to maximize your credit score. It's a big factor in what your interest rate is, right? So your interest rate, the factors that impact your interest rate are your credit score, the occupancy of the property, what kind of property it is, how much you're putting down. But that credit score is a big, big factor that impacts your rate. The next one is, the next biggest factor is how long you've had your history on each one of those trade lines. So a lot of people find credit cards that they're not using and they close them. Big mistake. Keep those balances at zero, keep them open, let that history build over time, and that'll help your credit score. The next factor is your mix of credit. So do you have some installment loans, some revolving credit and things like that? And then the other one that's least impactful is new credit. So people stress out over inquiries. I've had people who have maxed out credit cards worried about their inquiries while they should be really working on paying down their credit cards versus worrying about the inquiries. Inquiries are not super impactful. If you open a ton of credit cards and have a ton of inquiries, it could damage your credit score. But the most impactful credit inquiries are for consumer credit, places like Macy's, Home Depot, Target, things like that. The next worst are inquiries for credit cards, then auto loans, but mortgage is the least impactful. So mortgage also has a feature where you can have your credit pulled by multiple mortgage companies within a short time period, and it all counts as one inquiry. For a mortgage inquiry, you're probably looking at maybe 3 to 5 point impact on your credit score that'll hit your credit score maybe 45 days after the inquiry actually occurs. So not a big concern. And I know that's something a lot of people worry about. So what are the minimum FICO scores? So generally, FHA and VA will, from a guideline standpoint, they'll go down to a 500 credit score. But we're really looking at 580 for FHA and VA as a credit minimum. We can certainly look at a lower credit score if you have that issue, but there's another requirement in FHA where you need to have a clean credit history over the last 12 months. And if you do that, you're probably in that kind of, if you had some credit issues in the past, you're probably in that mid to high 500 zone. So that's the target we're really looking for to start working with that. Conventional, we're looking at about a 620 minimum. And then jumbo, we can go down as low as 660 on jumbo with 20% down. So the trade jumbo has a secondary requirement usually when you're getting those larger loans. If you're a first-time buyer and you don't have a mortgage history, they're looking for at least 3 trade lines that have been open for a couple of years. They want to see that you have some kind of credit history. We do have one jumbo product though that goes up to a $1.5 million loan amount that really just follows the conforming guidelines, where you don't necessarily have to have the trade line requirement. So if you're looking for a jumbo loan and you're talking to lenders and you've run into some kind of issue where you don't have what they call the credit depth, let me know, because we may have a solution for you when it comes to that. Once we've looked at income, assets, credit, and we've reviewed everything, we've had our underwriter look at it and blessed everything, then you're officially pre-approved. At that point, what we want to do is talk about determining your budget. The way we do it on our team is that we'll set up a Zoom appointment with you. We'll do a screen share. We'll pull up a spreadsheet like the one you see on the screen. We'll let you know what your max approval amount is, and we'll kind of work backwards from there. Like Connie mentioned at the beginning, there's really not one single, right answer for everybody when it comes to this, but because everybody has different plans. Do you have kids? Do you not? But talking to a financial planner at this point is super helpful. Once we let you know your max pre-approval amount, then most people are going to run into one of 2 issues: is the monthly payment gets too high, or they run out of cash to close. And a financial planner can definitely help you kind of work the numbers into your overall life plan and what you want to do. This spreadsheet that I share with my clients has 2 variables at the top. It's got the purchase price and the down payment that you can play with. We customize these spreadsheets for different loan products. If you're going to get FHA or VA, it would look very different. This one here is for a conforming loan in the high balance Bay Area, $800,000 loan. We plug in the rate, what the monthly payment is, the taxes, the insurance we expect. And this number here would be your overall monthly kind of budget for your house. These rows all talk about monthly payment. The rows at the bottom here put together your cash to close. So not only do you have your down payment, you have your closing costs, which can vary greatly depending on where you're buying a property. So again, it's important to talk to a lender who definitely knows the landscape and things like, city transfer taxes, county transfer taxes, who pays for them, who's going to pay escrow, who's going to pay title. All these things could be variables in your closing cost scenario. The closing costs here, they come from a separate page. This page here is the second tab on the worksheet. It itemizes all the closing costs. This bucket up here talks about the lending related charges, things like appraisal, credit report. There's a bunch of third-party expenses that are required that go to other companies. Then there's the underwriting and processing fee that's charged by our company. This box here in the top right has to do with escrow, title, government charges, and things like that. When you find a house and your offer's been accepted by the seller, one of the first things that'll happen is that they'll open escrow. Escrow is a neutral third party that represents your interest and the seller's interest. For you, they make sure that the seller is the legal owner of the home, that when, at the conclusion of the transaction, all of the deeds and everything have been filed correctly with the county. At the title insurance is issued by the title company. In California, we deal a lot with bundled services where the escrow and title is all one company. There are two title insurance policies required. One is the lender's policy, which protects the lender's interest, and the other is the owner's policy. The owner's policy is a policy that protects you from any kind of issues and clouds on title and things like that. The title company is going to do research to make sure that the home that you're buying is actually being sold to you by the legal owner, and that once it's closed and you own the property, that no one can come along and say, my grandmother gave this house to me, 20 years ago, and this is actually my house. So you're insured against any kind of clouds or liens against the property. The government charges could really vary, again, depending on the city. In Oakland and Berkeley, there's a really expensive transfer tax. There's not a transfer tax at all in places like Orinda or San Mateo or Marin or San Diego, for example. So again, knowing what the different rules and regulations are with regard to the transfer taxes and who pays what is really important to try to get that budget right when you're looking at your closing costs. Down here is the beginning of your prepaid items. The top two boxes are one-time expenses that you're never going to see again. Those are just transactional fees that go with getting the loan and buying the home. The bottom two boxes here are really the beginning of home ownership and the expenses that you're going to incur over and over again over time. So when we close the loan, we collect interest from the day of closing until the end of the month. So you get the money the day that we fund the loan, and we're going to take the interest and calculate it from there to the end of the month, so that you're paid up for that month, and then your monthly mortgage payment will actually begin at the beginning of the following month. So if you close on March 10th, part of your closing costs will be 21 days of collection of March interest, and then your first mortgage payment will actually be May 1st. There'll be nothing due in April. Your first year of homeowners insurance is going to be collected at the close of escrow. And that number is going to be based on the insurance that you choose. And Scott's going to go over some of the details on insurance. Going back to this budgeting here for the monthly, you have two choices on how to handle your mortgage payment. You can either just pay the mortgage every month, and then you'll be responsible for paying your property taxes and your insurance bill when they come due. Or you can bundle them all together and send in this case, this $47.47 on a monthly basis, in which case the lender will collect that taxes and insurance, and they'll keep that in a bucket on the side for you in an impound account. So what that impound account is a savings account in your name that they maintain. And when those taxes and insurance come due, then they're going to make the payments for you. It's a way to have a forced savings account instead of having to get hit with those big bills when they come due on your own. If people, if you prefer to, save your money on your own, budget on your own, then you can definitely just manage your own finances and pay that yourself. If you don't want to, like I said, get a big, $5,000 bill twice a year from property tax, then you can send it in. If you choose to have an impound account, it will increase your cash to close with this impound bucket here, because based on what month you're closing, the lender is going to need some kind of deposit from you initially in order to be able to have enough to pay the taxes when they come due. And that's something that we can walk through again. It gets a little confusing, but it's easily explained, and we can walk through that. So now you're pre-approved, you figured out your budget, and it's time to find a home. So at this point, what we would do is we'd communicate back out to your realtor and let them know that, hey, we've met, you're pre-approved, your file's been underwritten and fully approved, and you're ready to find a home. And this is where I really advise people work with a great realtor. We've actually got a poll. I'm kind of curious. If you're watching on Facebook, you probably won't see the poll, but I'm wondering how many people here are actually, working with a realtor right now. So I'm going to put this up on the screen, and you can answer. The question is, are you currently working with a realtor? And looks like we have a pretty mixed bag here. Actually, a lot of people are not. Okay. I'll give you a couple of seconds to answer here. All right, so it looks like 2/3 of our group is actually not currently working with a real estate agent. Um, so what do you do? What are the factors in finding a realtor, right? Thank you for answering the poll. I'm now going to end the polling. Um, what are the factors? So what that disc you see there, that's from the National Association of Realtors when they polled people. That those are the factors that have come into play when people have said, why did you choose the realtor that you chose, right? There could be a lot of different factors. You might have a family friend or something like that. You might find someone online. It could be that, working with a great realtor can really be the difference between you getting your offer accepted and not accepted. Them knowing the market landscape, figuring out exactly what to offer. It's really competitive. Inventory is tight out there nationally right now. So in most markets, working with a great realtor can really help you. So they need to know the landscape of the market. Are houses going for over asking or not? Are they going to reach out to the other agent and find out how many offers are coming in? How are their negotiation skills? What's their reputation in the market, right? Are they somebody that everybody else likes to work with or not? We've worked with a ton of agents in a lot of different markets all over California. So if you need an introduction, actually, I think I have another poll question. So for those of you who are not currently working with a realtor, let me know. I'm going to launch another quick poll. Would you like an introduction to a great local realtor in your market? If you would, I'd be happy to hook you up with someone. So I'll give you a second to answer this one. All right. All right. Closing the poll. Got it. Okay. For those of you who said yes, we'll definitely get you guys connected with someone. So then find a home with your realtor. That's often a long journey right now. Some people get lucky and get their first offer accepted. Other people get unlucky and it takes months and months. Usually it's somewhere in between, right? You get a couple of offers where you didn't get in, but eventually you find the house, then it always ends up being the perfect one. So if you don't get the right one, don't be too sad about it. So writing an offer. This is where we team together with your realtor. Certainly the price, you're going to team with your realtor and come up with what you think the right price is to offer. We're going to issue a pre-approval letter based on the price that matches. So even if you're pre-approved to $1 million, but you want to offer 910 on the house, we'll send a pre-approval letter for 910. A lot of times the agents will ask for a personal letter that talks about you guys. That there's some guidelines and regulations around that. You got to talk to your realtor about. One of the things they're going to ask about is contingencies. So how long do you need, and do you even need these contingencies? Again, we could do a long time on what these are, and I'm happy to dive into these with you. But once you've been fully underwritten, fully approved, there's a good chance that you're not going to need a loan contingency. And what that communicates to the seller is that this is a rock solid offer, that you're not going to all of a sudden not be able to get a loan halfway through. So that's a big factor that we try to help you with. The other one is the appraisal contingency. Are you concerned about the appraisal value? And this is again a deal by deal question that we have to kind of look into. There's not one answer for everyone. So depending on how much extra cash you have, depending on how, what your thoughts are about the property, we can figure that out. And the other thing they ask us is the closing time frame. So right now we can definitely close in as little as 21 to 24 days, especially once you've been fully pre-underwritten and approved. We can get loans through the system really quickly. And we're supported by a great team. So that's when you're choosing who to work with, that's going to be one of the factors. And then once your offer's in, you're going to have your deposit that is usually 3% of the purchase price. As soon as your offer gets accepted, then you have to put that 3% in. That's what's at risk if you don't perform, right? And that's what the contingencies protect. But again, the contingencies communicate to the seller that you have some concerns around your offer. So that's another thing that we're discussing and when we're kind of as a team trying to craft the offer. And then what's your cash to close? Are there reserves required? Do we have all the funds documented and all that stuff? So these are the things that all kind of come into play when you're writing your offer. But your real estate agent's gonna coach you through that stuff along with us. hopefully once your offer's in, now you're in contract, right? So once you're in contract, we're on the clock. There's a definite close date that we're all trying to hit. Escrow will get opened right away. We're going to go through your file. We're going to update all of your documents at that time. You're going to send in that initial deposit to escrow, that 3%, and we're going to order the appraisal and set up insurance. Now, insurance is a big, big deal, especially in California right now. I've been going for a while. I want to bring Scott in right here to talk a little bit about the insurance. As soon as I'm, and then I'll jump back into this slide. But Scott, if you could talk a little bit about, some of the factors in getting California insurance, given the fires and everything that's happened, kind of what first-time buyers need to think about, that'd be great.
Sure. So, homeowners insurance has been greatly affected by a few things. I would say that the age of the property can affect rates based on the age of the plumbing system can certainly affect just kind of discounts that are available for a property. But the big thing around California is wildfire risk and where that property is located when it comes to the amount of slope and fuel around a property. And what I try to let everybody know is every property is insurable. It's just a matter of what it's going to look like cost-wise and quality-wise. So there are options for everybody. It's just it's very good to get ahead of it and try to get an idea of what kind of options are available for that buyer for that property. So those are the big factors that are working out there for most of the companies trying to insure properties.
Right on. Thanks, Scott. And again, if you guys have any questions, I've worked with Scott for years. He definitely knows his stuff, and he's talked a lot of people through a lot of questions, and he does a fantastic job. So his contact information is right up there on the screen there. So once you've got the insurance set up, we're getting your file into underwriting. So now, even though you've been pre-approved, we go through the underwriting process because now they're looking at your purchase of this particular property. They're looking at the appraisal of the property. They're looking at all of the details in your file. And usually there's some conditions involved as we go through underwriting, but if we've really pre-approved you well and done a great job, and this part shouldn't be too much of a hassle. Once we're done with underwriting, you wire your funds to close, sign your loan documents, we fund the loan, the deeds get recorded, and it's moving day. So that's kind of a big overview of the whole process. The last slide I have is in terms of, who do I want to work with as a lender? There's a million lenders out there, right? Between online and all that stuff. So a couple last things to think about here is basically there's three different channels of origination, what we call it, right? So when someone works with a borrower and they start a loan, it's called originating a loan. So you can either walk into a retail bank, right? You can walk into B of A, Wells, Chase, or whatever bank. You can work with a broker who takes your information and then sends that off to a lender to be underwritten and approved. Or you can work with a direct lender. We are a cross-country, working with my team, you're working with a direct lender. And what that means is that we draw docs, we underwrite, we fund the loans right here. It doesn't leave the building. If we need to change something, if we were going to go Fannie Mae, we have to go Freddie Mac. If we were going to use one jumbo loan option, use another. Nothing changes on your side. We just kind of redirect the loan. If you're working with a broker, you get the advantage of them being able to look at multiple, loan options like we have as well, but they don't have full control of it. So if one of the lenders they submitted to can't get the loan done, they have to pull it all the way back and resubmit it to another lender. So you have the personal access that you have with us, you have the choices, but you don't have the direct control of the file when you're working with a broker. With a retail bank, you have the reputation and everything of walking with a retail bank, the convenience of having a certain place where your checking and savings might be, but you lose choice there because banks generally don't have the breadth of loan options that working with a direct lender or a broker might have. So it's kind of a pick and choose of where you want to go. So not having the options could mean something as severe as not getting a loan because you don't fit into their specific set of guidelines, whereas we might be able to do something for you. But in terms of, it might also mean something in terms of rate, because they have their one product that they're selling, whereas we can look across multiple products and try to shop the best rates for you. So that's the big question, is what kind of company am I working with? Questions to ask your lender: do you sell directly to the agencies? Are you a direct Fannie Mae, direct Freddie Mac seller? Do you securitize your own Ginnie if you're getting an FHA or VA loan? Who does your appraisals? Are you outsourcing that to some other large national company, or is that a company that you're familiar with local appraisers that you work with? How many investors do you have? And again, in the most of the world, the term investor is people who invest their money into different companies. In the lending world, investors are loan options, basically, right? So how many different types of investors do you have? How many different kinds of loans are you going to be looking at for me? How many days does it take for you to close a purchase? That could mean the difference between your offer getting accepted and not accepted in a competitive market. Do you fully pre-underwrite your files? So on our team, we have a unique situation where an actual underwriter is a member of our team. So all of our files get pre-underwritten, regardless of the volume at the company. There have been so many massive amount of mortgages in the system because rates are low right now that a lot of companies have moved away from underwriting what they call TBD, or to be determined files. So that's a big factor. Are you going to be fully underwritten and approved when you make your offer? What's the interest rate for my scenario? Obviously, that's a big factor. Are you going to be, what are you going to be getting charged for your credit score, your down payment, your type of loan, and all that stuff? What are the fixed costs associated with working with that platform? And another big thing is my information secure? What we've seen is a trend to a lot of outsourcing lately, where people are doing underwriting, processing, and things like that in foreign countries. People, in the Philippines, China, India might log in and perform tasks. And if you think about what's on your loan application, it's the holy grail of identity theft, unfortunately. So security is a big, big factor. You want to make sure that on those 3 pages of the loan application, your name, your social, your address, all of your bank account information, all of your credit information, your birth date, all that stuff is right there. So security is a big, big factor when you're working with someone. You want to have a really good comfort level that they're taking care of your information. And what's the privacy policy? Is my information going to get resold to a million different people selling me everything from moving services to paint to whatever? So if you're someone who doesn't want to get a ton of email and text as soon as you buy a home because your information's been sold, then you want to take a look at people's privacy policy there too. So I think these things are all important factors. That does it for the webinar. We've been going for about 50 minutes. I really appreciate you guys all attending this. Again, if you want to reach out to me or Constance or Scott, I should have put Scott's info on here. Sorry about that. But if you want Scott's info and you didn't grab it off that previous slide, email me or Connie, then and we'll get it over to you. But that's it. Back to you, Constance Young.
Okay, unmuting. I just want to concur with what Faramar said. I think there's a lot of, as I said, moving parts and pieces. So when you are starting on your journey towards homeownership, it's important to consider more than just what, can I get a loan, or should I sell my stock, or all those things. I'm always happy to speak with anybody just to kind of run you through the various scenarios and to take into account any tax considerations if you are selling stock in order to fund that down payment. And just, as I said, to look at the bigger picture and evaluate some of your other financial goals and how they can be worked into the mix in terms of home ownership, which is the main goal here. Faramars, thank you for hosting all of us.
Oh, you got it. So we do have a question. Hey, Eleni. So she's asking, how can you judge a realtor's reputation? That's a great question. Fortunately, there's a ton of online resources available for that. So you can go to Zillow, Yelp, or look at any of the Facebook reviews, Google business reviews. There's a few different places you can look and see how people's experience has been with them. And a lot of times on these great websites, when someone puts a great review, they go into great detail about what the process was with them and everything. You can also potentially ask them for references of recent clients that they've worked with and see how their experience was. It's a little bit harder to judge how they're viewed in the realtor community. If you know other agents, you can ask around maybe, but I think those online resources are a great place to start.
I think I'd just also like to add to that, it's good to talk to several different realtors. So there's sort of a dynamic about how you interface with people. And I've certainly had people call me looking for a financial advisor, and it's not that there's anything wrong with them or anything wrong with me, just personality wise, we weren't a great match. And I think that's true with realtors too. You need to find somebody that you can really collaborate with and feel connected to, because it's a pretty important decision to be making.
And then Michael was asking Connie, what's the difference between RSU, restricted stock units, versus stock options and equity?
Okay, so
is that a whole other seminar?
No. I can cover it pretty briefly, and of course, anybody's always welcome to call me if we want to do more of a deep dive. In the early days of Silicon Valley, they used to give stock options, and an option is exactly that. It is the option to purchase stock at a set price. So the way that they incentivize their employees is they say, oh, Apple stock is trading at $136 a share today, but we give you the option to buy Apple at $20 a share. But you have to exercise the option and actually buy the stock. So there's a cost associated with exercising the option, even though the cost is generally much less than the value of the stock. It's rare these days for larger companies to give their employees options. Instead, they give them something that is an RSU, a restricted stock unit, and they basically give them a certain number of shares of company stock. They kind of give it to you and they kind of don't, because it has a vesting period. So they might say to you, oh, we just hired you. Welcome to the company. Here's $100,000 of stock. But generally, you're not allowed to sell that stock until you have worked for the company for a certain period of time. So the vesting periods can be anywhere from 1 to 10 years. Usually it's sort of vests over a 4-year period. So that means if they give you $100,000 worth of stock, it's not really worth anything to you for the first 12 months because you can't sell it anyway. But then on your 1-year anniversary, you can sell the first 25% of that stock. And I'm not going to go into how they're treated differently tax-wise. There's different tax treatment for options and for RSUs, and anybody can call me if they want to know more about that.
As you can see, Connie knows her stuff. Genius. Lisa's asking, what are some other good questions to ask and interview lenders? I think we pretty much covered it on that slide, Lisa, but possibly the most important, like if I was to prioritize there, certainly rates and fees are important, but in general, you're probably going to be in the same kind of ballpark, especially in a conventional loan. Unless you're dealing with someone who's going through intermediaries to get to Fannie Mae, if you're dealing with two lenders that are selling direct to Fannie Mae, the rates should be pretty much the same. So it comes down to the fees. It's more the process, because what you really want in your lending partner is someone who's going to maximize your ability to get your offer accepted, right? So is my file going to be fully underwritten before you issue me the pre-approval, or is it just you taking a look at it and telling me you think it looks good, right? That fully underwritten is a big factor. And I think the other one is how quickly can you close, because sellers really look at that when offers are coming in. So I think timing and preparation and the attention is probably an important thing. And then, I can't tell you how much work we do on the weekends, because just like realtors, we have to be available. If you're working with a big bank, you may not be able to get that pre-approval letter on Saturday or Sunday, or at 7 o'clock at night when it's needed. And that could be the difference of getting your offer accepted. How available is the lender that you're working with at that time? Michael's asking, what does fully underwritten mean? So great question. So what that means is that not only has the loan officer that you're working with looked at your file and reviewed it, but the actual underwriter, who's eventually, that's the hat that they wear, is the underwriter is the one who gets all of the documents and stamps it approved and gives the clearance for us to send our funds to close. That person has actually looked at the income, assets, credit, and they've stamped it approved. That means nothing's been missed at that point. All of the necessary documentation to get the approval is in the file. So not only does it help you close quicker when your offer does get accepted, it means that you don't have to have a contingency. It means that you can make an offer as long as the property's in good condition. That's the one unknown. But that you have the confidence and you can communicate that to the seller that you are ready to close. That there's no mysterious thing where 3 weeks from now the lender's going to come back and say, "Whoops, we missed something," and you can't get the loan all of a sudden. Scott's asking, will there be a link to see this present? Yes. No, it's being recorded, Scott. This is being recorded and we're going to put it up and there'll be a link to everybody who's here. We'll get a link to the presentation. Can we use cash for down payment? No. So we covered that in the asset section. You have to deposit your cash into the bank for at least 2 months for us to be able to use it. I think that's it. Bitcoin, no cryptocurrency yet, Shemaine. Very funny. I know that you have billions in Bitcoin with Elon Musk right now. You're dying to use it, but right now cryptocurrency is not being used. Again, you have to put the crypto into the bank for 2 months, and then we can use it.
And there's another question in saying, do we have to show where it came from? So
not after 2 months. So we only need 2 months of bank statements. If you're depositing cash, we don't want the statement where you deposit it. So if you have a bunch of cash and you're going to deposit it in February, we'll use your March and your April bank statements, and you can purchase a house in May at that point. You have to wait 2 or 3 months. You got it.
Thank you, everybody.
All right, you guys, thank you very much again for attending. If you have any questions, please email me, call me, whatever you need.
Yeah, we love to hear from you. And we really get excited when people get into their first homes. For the record, when my clients buy their first home, I bartend at the housewarming party.
There you go.
Obviously, we're not having a lot of live and in-person housewarming parties these days.
That's an easy offer to make right now.
Yeah. All right. Thanks, everybody.
All right, you guys, take care.